Do me one favor before anything else. Pause this video for just a second and look at the number on your screen. Open your trading app, your brokerage account, or any financial news site. You'll see silver flashing somewhere around the low to mid $70 range. It looks calm, it looks controlled, it looks normal. And that illusion is exactly what makes this moment so dangerous. Because that number is no longer the real price of silver, it is a reference price, a paper placeholder, a digit produced by a market structure that is cracking under stress. While the West stares at a frozen screen, the real silver market is already operating in a different reality, and the gap between those two realities is growing by the day. Right now, as you're watching this, physical silver is changing hands in parts of Asia at prices that would sound insane if you only relied on US spot charts. In Tokyo, verified street transactions are occurring near the equivalent of $130 per ounce. In China, physical premiums are pushing silver above $100. In the Middle East, dealers are demanding over $115 just to part with real metal. This isn't rumor. This isn't hype. This is happening quietly, transaction by transaction, outside the Western paper system. What you're witnessing is not a normal spread. It's not supply and demand noise. It's a fracture, a structural break between paper silver and physical silver. And once a market fractures, it never heals gently. It snaps. To understand why this is happening, you have to forget everything you've been taught about how commodities are supposed to trade. You've been told that arbitrage fixes everything, that if a price gap exists, traders will step in, buy low, sell high, and close it instantly. That's true in theory, but theory assumes a frictionless world. Silver does not live in a frictionless world. Silver is heavy, it is bulky, it is expensive to move, insure, and store. It requires armored transport, secure vaulting, export clearance, and geopolitical stability. And right now, every single one of those systems is under strain. When friction enters the equation, price gaps don't close. They widen. Japan is the first domino, and there's a reason for that. Japan's financial system is under extreme pressure. Their debt to GDP ratio is over 260%. Their central bank has lost control of the bond market. Yield curve control is failing. The yen is weakening, and the public knows it. Japanese citizens aren't buying silver because they expect a short-term trade. They're buying because they're afraid of holding currency that is melting in real time. When fear enters a market, price becomes irrelevant. Survival pricing takes over. A salaryman in Tokyo doesn't care what comic says silver is worth. He cares about preserving purchasing power. And if that means paying $130 for a coin that protects his savings, he pays it without hesitation. That's not speculation. That's capital flight. Now look at the United States. On paper, silver trades at $73, but try to buy it. Go to a major dealer, look at 100-ounce bars, which normally carry the lowest premiums in the market. You'll see prices closer to $80 or higher. That's a $7 to $8 premium on wholesale metal. Coins? Even worse. Eagles and maples are trading at 15% to 20% above spot. That tells you everything you need to know. The spot price is not a clearing price, it's a reference price for derivatives. The real floor of the US physical market is already significantly higher, and that's before the global arbitrage pressure fully hits. So now we have a three-tier market. Paper silver in New York, physical silver in the United States, and panic-priced silver in Asia. The further east you go, the higher the price becomes. That is not coincidence. That is capital flow. That is metal moving toward regions that value it most. And here's the critical question. Why doesn't arbitrage close the gap? If silver is $73 in New York and $130 in Tokyo, why don't traders buy every ounce in the US, ship it to Japan, and pocket the difference? The answer is simple and terrifying. They are trying, but they can't move the metal fast enough. Secure logistics capacity is maxed out. There are only so many cargo planes certified to carry bullion, only so many armored trucks, only so many vaults capable of processing large-scale transfers. Right now, those pipelines are full. Every available route is already moving metal east. Insurance is another choke point. War risk premiums have exploded. Shipping metal across contested airspace, through unstable regions, or across sanctioned corridors is no longer cheap or easy. Insurance costs eat into arbitrage profits, forcing Asian prices even higher to compensate for risk. Then there's the vault problem. Most silver in Western financial centers is held in unallocated or pooled form. It exists as a ledger entry, not a specific bar. When a holder requests allocation and delivery, the bank often has to locate the metal first. That takes time, weeks, not days. In a squeeze, time kills arbitrage. This delay is not accidental. It is a feature of a fractional reserve bullion system. As long as metal sits as digital entries, the system works. The moment too many people demand physical delivery, the illusion breaks. And that brings us to the most important development of all, China. Quietly, methodically, China has implemented an export licensing regime for strategic metals. Silver is now effectively ring-fenced. Only a limited number of large refiners are authorized to export. Smaller producers are locked out. The result is that a massive portion of global refined silver supply no longer leaves China freely. This is not an outright ban. It's smarter than that. It's a bureaucratic chokehold. Metal stays domestic by default. And while the West debates paper prices, China accumulates physical supply. This is why Shanghai inventories are stable, while London inventories drain. This is why premiums in Asia keep rising. China understands something the West refuses to admit. In a world of financial warfare, physical resources matter more than paper claims. Now look at the Middle East. Dubai has become a vacuum for physical metal. Wealth in the region is fleeing fiat currencies, sanctions risk, and Western financial control. Silver offers something no paper asset can. No counterparty risk, no freeze, no permission required. But Dubai is being bypassed by traditional supply routes. Swiss refiners are sending metal east to capture higher premiums in China and India. That forces local dealers in the Gulf to raise bids aggressively. The result? Prices north of $115 per ounce. South Korea tells the same story, not from investors, but from industry. Korean manufacturers are paying close to $100 per ounce because production lines cannot stop. Samsung, LG, SK Hynix, these companies do not speculate. They secure supply. When they bid, they set the real floor. This is replacement cost pricing. When the cost of not having silver exceeds the cost of overpaying, price becomes secondary. And that is exactly what we're seeing. Now step back and look at the map. Japan at $130, Dubai at $115, Korea near $100, China above $110, the United States at $73. What happens when you're the cheapest market on earth? You get drained. Every ounce that can leave the US will leave. Futures holders stand for delivery, physical bars disappear, coins vanish, the vault's empty. This is Gresham's law in real time. Bad money drives out good money. Overvalued dollars drive undervalued silver out of the system. And yet the paper price refuses to move. Why? Because the banks cannot let it. Bullion banks are trapped on the short side of the market. They sold promises they cannot fulfill. For years, this worked because few demanded delivery. But now delivery demand is exploding. And the real price is far above the paper price. If silver were allowed to rise freely to $130 in New York, the mark-to-market losses on these short positions would be catastrophic. Tens of billions, possibly more, losses large enough to threaten Tier 1 capital requirements. This is no longer about profit. It's about survival. So the banks defend the paper price at all costs. They print contracts. They flood the market with synthetic supply. They create selling pressure that does not exist in the physical world. And every time they do this, they make the problem worse. Because cheap paper silver incentivizes physical buyers to take delivery and ship metal out of the system. The defense accelerates the collapse. This is why the COMEX inventories have fallen over 70% since 2020. This is why registered silver is critically low. This is why delivery delays are growing. The system can only survive as long as there is metal left to deliver. When that runs out, paper prices become meaningless. This is not a question of if. It is a question of when. The global silver market is no longer unified. It has split into regions governed by physical reality and regions governed by financial fiction. And history tells us how this ends. The paper market does not pull physical prices down. Physical scarcity pulls paper prices up, always. What you're witnessing right now is the early stage of that adjustment, the calm before the repricing. The moment when screens lie but streets tell the truth. And once the two prices reunify, they will not meet in the middle, they will meet at the highest bidder. The next layer of this story takes us away from street prices and dealer premiums and straight into the core of the financial system itself. Because price fractures like this do not happen unless something far deeper is broken. And what's broken right now isn't just silver supply. It's the balance sheets of the institutions that control the paper market. For decades, bullion banks have acted as the market makers for silver. They positioned themselves between miners, refiners, industrial users, and investors. When a miner wanted price certainty, the bank sold futures. When an ETF needed exposure, the bank provided swaps. When a hedge fund wanted leverage, the bank wrote derivatives. The system worked as long as silver remained a sleepy, under-owned metal, and physical delivery requests stayed low. That era is over. Over the last several years, demand for physical silver has exploded, but the paper market continued operating as if nothing had changed. Banks kept selling contracts they had no intention or ability to settle with real metal. This is known as naked shorting. It means promises were created without underlying inventory. As long as contracts rolled forward and investors settled in cash, the illusion held. But illusions collapse when people ask for the real thing. Today, delivery requests are rising at precisely the wrong time. Inventories are depleted, export restrictions are tightening. Industrial users are desperate. And suddenly, the banks are facing a scenario they never planned for: a rising price in a market where they are massively net short. This is where the concept of a solvency ceiling becomes critical. A solvency ceiling is the price level at which a financial institution can no longer absorb mark-to-market losses without breaching regulatory capital requirements. It is not a theoretical number, it is a hard line. Cross it, and the bank risks regulatory intervention, forced liquidation, or outright seizure. In silver, evidence suggests that this ceiling sits somewhere between the high 70s and the low 90s. Notice the behavior of the market. Every time silver approaches these levels, massive sell walls appear, not normal profit taking, not hedging, defensive selling. Unlimited paper supply deployed with surgical timing. This is not about making money. This is about preventing death. If silver were allowed to trade freely at global physical prices, losses on bullion bank short positions would dwarf their quarterly earnings and potentially wipe out their Tier 1 capital. Regulators would step in. Shareholders would be wiped out. Careers would end. So the banks do the only thing they can do. They suppress. But suppression is not free. Every contract sold to defend the price increases the size of the short position. Every defensive action digs the hole deeper. This is the same dynamic that destroyed the Hunt brothers in 1980, except inverted. Back then, buyers overreached. This time, sellers did. The silver market is now caught in a classic feedback loop. Suppression encourages physical demand. Physical demand drains inventories. Drained inventories increase delivery risk. Delivery risk increases panic. Panic increases physical demand, and the cycle accelerates. At the center of this storm is the COMEX delivery mechanism. Futures contracts were never designed for mass physical settlement. They were designed for hedging and cash settlement. Only a tiny fraction of contracts were ever expected to result in metal changing hands. That assumption no longer holds. Registered silver inventories on the COMEX have fallen by more than 70% since their 2020 peak. Eligible inventories look large on paper, but eligible metal is not committed to delivery. It belongs to someone else. And when prices are rising, those owners are not eager to part with it. This creates a dangerous mismatch. Open interest remains high. Physical backing does not. In any other commodity market, this would already have triggered a crisis, but silver is special. It sits at the intersection of finance, industry, and geopolitics. The system will fight longer to preserve control, which brings us to the next lever: rule changes. When markets break, exchanges do not admit failure. They change the rules. They increase margin requirements. They limit position sizes. They halt trading. And in extreme cases, they invoke force majeure clauses to settle contracts in cash instead of metal. This has already happened before. It is not hypothetical. If the COMEX faces a situation where delivery obligations exceed available metal, it will not default openly. It will declare an emergency. Contracts will be cash settled at a fixed price chosen to preserve the system, not the investor. This is why the distinction between paper silver and physical silver matters more now than ever before. A futures contract is a liability of the exchange. An unallocated account is a liability of a bank. An ETF share is a claim on a structure. Physical silver in your possession is an asset with no counterparty. In a crisis, liabilities get restructured. Assets remain assets. This is why sophisticated capital is moving quietly out of paper claims and into direct ownership. It's not about speculation. It's about counterparty risk. Now let's talk about arbitrage again, because this is where many people still misunderstand what's happening. Arbitrage only works when markets are liquid, transparent, and unconstrained. None of those conditions exist right now. Physical silver faces, logistical bottlenecks, insurance barriers, export controls, and vaulting delays. Secure air freight capacity is saturated. Insurers are charging war risk premiums. Vault operators are imposing allocation delays. Export licensing requirements are increasing paperwork and time. Each of these frictions slows the movement of metal. Together, they create a dam, and while the dam holds, prices diverge. This divergence creates a false sense of security in the West. As long as the screen says $73, people assume nothing is wrong. But the screen is lying. The screen reflects a market that cannot clear. The real price of silver is being set where physical metal changes hands without leverage, without derivatives, without rehypothecation. That price is already far higher. This is why industrial buyers are paying premiums. This is why governments are designating silver as critical. This is why China is ring-fencing supply. Hundreds of millions of ounces were repurposed for electromagnetic separation. The public never knew. There were no headlines. The metal simply vanished into history. Modern governments do not confiscate openly. They control through regulation, licensing, and priority orders. The Defense Production Act in the United States allows the government to require producers to fulfill federal contracts before commercial ones. Silver's designation as a critical mineral opens the door to exactly this framework. China's export controls serve the same purpose on the other side of the world. Keep the metal domestic. Ensure supply for industry and defense. Let prices rise elsewhere. These are not isolated policies. They are coordinated responses to the same reality. Silver is no longer abundant. The global silver market has been in structural deficit for years. Demand exceeds supply. The difference has been met by drawing down inventories. Those inventories are now dangerously low. Mining cannot respond quickly. Silver is primarily a byproduct. Higher prices do not instantly produce more supply. Recycling helps marginally but cannot close the gap. This means price is the only rationing mechanism left, and when rationing begins, it is never smooth. This brings us to the psychological phase of the market. As prices rise and availability tightens, behavior changes. People stop selling. Hoarding begins. Fear replaces logic. At that point, price becomes a secondary consideration. We are already seeing early signs of this in Asia and the Middle East. When Western investors finally realize what is happening, the reaction will not be gradual. It will be violent. This is why banks are so desperate to maintain control now. They know that once the crowd arrives, suppression becomes impossible. And this is where the system's greatest weakness lies. The paper market requires confidence. Confidence that contracts will be honored. Confidence that delivery is possible. Confidence that prices reflect reality. Once that confidence breaks, paper markets collapse overnight. This is not alarmism. It is a recurring pattern throughout financial history. The silver market is approaching that confidence threshold. Every drained vault, every delayed delivery, every widening premium chips away at the illusion, and once the illusion breaks, the repricing will not be linear. It will gap. At this stage, the question is no longer whether the silver market is broken. That debate is over. The evidence is overwhelming. The question now is how this ends, and more importantly, where you stand when it does. Because every market crisis follows the same arc. First comes denial, then confusion, then fragmentation, and finally resolution. Silver is now entering the resolution phase, and resolution in commodity markets never favors paper claims. It favors whoever controls the physical asset when the music stops. To understand what happens next, you have to understand how systems behave when they are pushed beyond their design limits. The silver market was never built to handle sustained physical demand. It was built to facilitate hedging, speculation, and liquidity under normal conditions. Those conditions no longer exist. And what we are seeing now is the slow-motion failure of a fractional reserve commodity system. Fractional reserve systems work as long as not everyone asks for delivery at the same time. Banks know this, exchanges know this, regulators know this, and right now, every one of them is hoping demand subsides before the vaults run dry. But demand is not subsiding. It is accelerating. Industrial users are locking in supply months in advance. Governments are securing strategic stockpiles. Retail buyers are waking up. And arbitrage traders are stripping physical metal out of Western vaults and sending it east. This is not a cyclical event. This is a structural unwind. As the available float of physical silver shrinks, volatility will increase dramatically. Prices will move faster. Gaps will appear. Trading halts will become more frequent. Margin requirements will rise. And participation will be restricted to those with capital, access, and speed. This is when markets become hostile to the unprepared. One of the most misunderstood aspects of late-stage commodity bull markets is the illusion of opportunity. When prices explode higher, people assume there will be time to act. They think they'll wait for a pullback. They believe supply will always be there. History shows the opposite. In every major commodity squeeze, availability disappears before price fully reflects scarcity. By the time the price confirms the thesis, the asset itself becomes difficult or impossible to obtain. Silver is uniquely vulnerable to this dynamic because it is both a monetary asset and an industrial necessity. Gold can be hoarded without disrupting civilization. Silver cannot. Remove silver from supply chains, and factories shut down. This gives silver a dual demand profile that becomes explosive under stress. At some point, industrial demand alone will overwhelm available supply. When that happens, price no longer clears the market. Allocation does. Allocation means some buyers get metal and others do not. Allocation means contracts are settled in cash. Allocation means priority users are favored and everyone else waits. This is not speculation. This is how strategic commodities behave under constraint. And this is where psychology becomes more important than charts. When people realize that silver is not just rising in price but disappearing from availability, behavior changes overnight. Selling stops. Hoarding begins. Panic spreads. At that moment, price ceases to be a signal and becomes a headline. $100 silver will not feel expensive. It will feel inevitable. $150 silver will not feel speculative. It will feel necessary. And $200 silver will not feel unbelievable. It will feel late. This is the mental shift that defines the final stage of every great commodity cycle. The narrative flips from, why is it going up, to why didn't I buy more? This is why institutional money moves early and quietly. By the time retail interest explodes, the trade is already overcrowded. But silver still sits in a strange limbo. The physical market knows the truth. The paper market denies it. That gap cannot persist forever. When it closes, it will not close gently. There are only 3 possible resolution paths. The first is a disorderly repricing. Physical supply runs out, delivery defaults occur, and the paper price gaps violently higher to match reality. This is the cleanest outcome, but also the least likely because it exposes institutional failure. The second is controlled settlement. Exchanges halt trading, invoke emergency powers, and cash settle outstanding contracts at an arbitrary price. This protects banks and sacrifices paper holders. The third is gradual rationing. Allocation rules tighten, premiums explode, and access becomes restricted while spot prices lag. This creates a 2-tier market that eventually collapses into the first 2 outcomes. All 3 paths favor physical ownership over paper exposure. None favor complacency. This is why sophisticated capital is no longer asking, what's the price? But can I get delivery? That question changes everything. Once the market shifts from price discovery to availability discovery, traditional analysis breaks down. Technical levels lose meaning, valuation models fail. Only one thing matters: possession. This is the phase where mistakes become permanent. Selling too early locks in regret. Waiting too long locks you out. Leverage becomes lethal. Paper promises become worthless. And patience becomes more valuable than precision. If you've ever studied previous commodity supercycles, this pattern will feel familiar. Oil in the 1970s, uranium in the 2000s, rare earths after export bans. Each followed the same script. Silver is now following it with frightening accuracy. The difference is scale. Silver touches every part of the modern economy: energy, defense, technology, medicine, infrastructure. A disruption here is not localized, it is systemic. This is why governments are involved. This is why policies are changing. This is why the market feels unstable. You are watching the collision between financial abstraction and physical reality. And physical reality always wins. At this point, the smartest move is not prediction. It is preparation. Preparation means understanding your exposure. Preparation means reducing counterparty risk. Preparation means owning what you think you own. If your silver exists only as a number on a screen, ask yourself who owes you that silver. Then ask yourself what happens if fulfilling that obligation becomes impossible. If your silver is allocated, segregated, and titled in your name, your risk profile changes completely. If your silver is unallocated, pooled, or derivative-based, your exposure is to the solvency of the system itself. History is unkind to creditors during crises. This is not about fear, it is about realism. Markets reward those who act before certainty arrives. By the time certainty is universal, opportunity is gone. The final phase of this move will not be announced. There will be no press release, no warning bell. It will happen overnight, during a thin trading session, when liquidity vanishes and reality forces a reset. And when it does, the conversation will change forever. Silver will no longer be discussed as a cheap metal. It will be discussed as a strategic asset that disappeared when people finally understood its value. Those who prepared will be calm. Those who didn't will be confused. That is how every transition ends. This is not the end of the story. It is the beginning of a new chapter in monetary history. Silver is stepping out of the shadows of gold and into its own role as a cornerstone of the real economy. And once that recognition becomes widespread, the price you see today will feel like ancient history. The window is still open. A narrowing, but open. What you do with that window is up to you.